This is the finance course, my outline. So today we'll talk about valuation and forecasting. The problem and the challenge with everything that has to do with investing is that it's like an Ouroboros, like this snake that eats its own tail. You have to start somewhere. You have to so I start with assuming that we already have some kind of numbers for the companies, and that we have created these forecasts in a due diligent way, and then I show you a couple of valuation techniques, and then in the second part I move on to assessing companies from a qualitative standpoint, assessing whether they are sustainable, if they have a sustainable business model, what their competitive landscape looks like, how uncertain your forecasts for growth and profit margins will be, and returns. And then we have the other sessions here where after like valuing a company, I take macroeconomics and technical analysis into account. I do want to stress already now that I think that macroeconomics and technical analysis, those are at best in very few extreme points, they are like a slight headwind or tailwind for your investment. But the focus should really be on the microeconomic factors, that is analyzing the actual company and its valuation, rather than trying to create some kind of a bigger picture framework and investing from that. There are a few very well-known macroeconomic investors like Druckenmiller and Soros. But there is a reason they are so few, and there's a reason that Warren Buffett and Charlie Munger always says that there is no value in macroeconomics. Then moving on from there, I mean the first three sessions, they take mostly into account like single stock analysis and valuation, but then it's time to put it all together in a portfolio, and the question here is then how should you combine the various investment alternatives that you have found? How many should you use? In what proportions? What kind of rebalancing schemes should you use between the stocks, depending on how they move in the interim? Session 5 and 6 are this is the Ouroboros again, biting its own tail, where I kind of circle back and show a couple of frameworks that I use for keeping track systematically of what I'm actually doing in my analysis and investing. Session 6 is more of an overview, questions, how I use annual reports, for example, to find information for building my valuation models. I think Andre Ganturo and I we talked beforehand about questions, and he will be moderating any kind of questions that you might have meanwhile. As I said, this is a practitioner's view of investing, and what I like to stress here that this is like the simplest and most robust way that I've over 28 years in finance have come to rely on, in terms of how to make very, very straightforward analysis of a company, the forecasting methods, valuation methods, and investing methods. And these we'll go through all of these things over these sessions. But now let's get down to today's topic. So to analyze, that means the actual word means to break down, to pick apart into components. And I think that's a nice mindset to always keep in mind when you are thinking about analyzing. Because it's quite easy to kind of get lost in what you're trying to do when you read the annual reports, you look at the stock price charts, and you kind of get lost in the process and lose track of what you're actually doing. So what this is about is to take the obvious data that is publicly available. Like, for example, you have the stock price. You know exactly what that is. You know the stock price and the number of stocks. You also know, for example, how much revenue the company has for a year and its profits. Those things you know, and everybody knows that too. And there is no real information in that data, but just breaking those numbers apart into their most into their components provides information that can then in turn be used. So what I do, this is the formula. So the stock price, it's composed of fundamentals and a valuation multiple. As easy as that. And using today's fundamentals, and fundamentals, that's accounting data. For example, sales, book equity, assets, costs, anything that you can find in a P&L or a balance sheet. And then every accounting data has its corresponding valuation multiple. So sales has a price sales multiple. It's just simple math. Price times price sales will, well, that's the price. And going from today's fundamentals to tomorrow's fundamentals, and from today's valuation multiple to a future likely valuation multiple, you can calculate a likely range for tomorrow's stock price. And going from tomorrow's stock price to today's stock price, you can calculate the compound average growth rate, R. So this is deceptively simple, but even among the most of my hedge fund peers, I don't really see this framework. This is not really how most people think about it, even though I think that this is both robust and powerful. So in this process of picking things apart, I start with the stock price, the fundamental and the valuation multiple. And then as step number 2, I move on to the level of uncertainty. When I speak about risk and level of uncertainty, I typically speak about how uncertain my projections for fundamentals are. And I estimate that uncertainty from past fundamentals and past valuation movements and past price movements. So, but most people in the market, they only use like past price movements. So they assume that volatility or standard deviation of the stock price, that is the risk. I only consider that a small component, like a pragmatic input for my thinking about risk, since if the stock price has moved around a lot, then that probably tells me something about how the market in overall views the risk of this company. But when I want to assess what the actual risk is in my investment. I think it's much more important how much sales and profits and margins and assets, how they have moved around in the past. Because what I'm trying to assess, I typically go about 4 years into the future, because in about 4 years after that, it's more or less impossible to make any meaningful projections. And it's also far enough into the future to create a kind of a normalized situation where current one-offs and current extraordinary situations, that they will, at least in terms of forecast, they will have evened out, and 4 years hence, you could consider the company to be normalized for all practical purposes. So the main risk that I see, that is, if I go from like sales at an index of 100 today, and let's say I have a projection of 160 4 years into the future, the question is, how uncertain is that 160? Because that will be the base for my valuation. So that's where the main risk lies. And then, of course, I also have to make some kind of a forecast of the future valuation multiple for that sales. But if I've at least pinpointed my sales estimate, and when I say sales estimate, I really mean fundamental estimate. It could be anything from sales, any type of profit, from earnings to EBIT to EBITDA, or cash flow even. But I typically revert to sales as my default position, because it's the most robust one and it's easiest to forecast. And the market often is willing to think that a certain amount of sales can lead to a certain amount of profits sooner or later, or else then the company will cease to function. Anyway, so my estimate here of risk, it's the uncertainty in terms of the forecast for the fundamental variable, the fundamental accounting variable. So analyzing is breaking down, picking apart into components. First, stock price, fundamental times valuation, then moving on to risk. And then I calculate a risk reward. Let's see here, I got a question, I think. Okay, so Gregory has a question. I'm not sure if I am the one to unmute you. I think you can unmute yourself, or maybe like this.
Yeah, hello.
Yeah.
All right. Can I?
Yeah.
Hello, Michael. Maybe I'm jumping ahead, but I would like to know, I agree that it's very hard to forecast the future, especially after the 4 year, but how you determine what is the fair multiple after the 4 year, if you have not forecasted what is the growth profile of the company after the 4 years?
Yeah, that's a very good question, of course. And a very long time ago, like back in the 90s, when I was working as an analyst, and we were going to float a new company, we were the lead bank for their IPO. And when we sat down with management and asked about their forecasts, for their vision for the company, and how they saw the future, and then the CEO, he said that, I can't give any projections more than 3 or 4 years ahead. I have no idea what will happen 4 years hence. And then my boss told him that, well, in that case, we can't give you more than PE 3 or 4 at the IPO, because if you have no idea what happens after year 4, then we have to assume it's 0. So of course, I too have to make some kind of a. I have always have an idea of what happens after year 4. And we'll actually get to my my process for estimating future valuation multiples, but we to at least give a flavor of it now. If this is a company that's pretty early in its growth stage, then it will probably not be done by year 4. You can more or less safely assume that a certain type of company will grow faster than the average company, even after year 4. So I would categorize companies at the stage of year 4 from either being like a quote unquote growth company, or a more typical average index company. And in case I foresee the company to be more or less an average company, then by year 4 I will use what has been an average range for either the market or that industry, or similar peers in the same stage of development. So it all comes down to finding relevant examples. And if I have no other information, then I will assume that the average market multiple will be well, it will be my best guess for that company as well. But if I've let's say I'm analyzing Meta platforms, formerly known as Facebook, then if similar companies have traded at much higher multiples for a prolonged period of time than the market has, then I probably have to assume that the market is likely to value Meta at those elevated multiples even in the future. And also, if I have a good grasp of a certain industry, and I have made a qualitative analysis and assessment of a certain company, then I probably have a pretty good idea of how this company will look 4 years into the future as well. Is the market close? Well, is the company close to saturating its total available market or not? Is it like a stable, typical heavy industry company, or is it a software company with a huge potential market? Then I will categorize that the latter as a growth company, and the former as just an average company. So, but we will get to the to how I identify relevant valuation patterns for various companies. All right, Sam has a question. Sam Gautam.
Yes, hi, thanks, Michael, again for taking the time. I had a question around sort of, as we mentioned, the DCF is probably like the closest methodology to fundamentally valuing a company, but obviously it takes time and it's inaccurate, so we kind of sometimes simplify it to multiples. And when we look at multiples, and if you go down the P&L statement, there's obviously different approaches. So we say a sales-based multiple is probably not the best because it doesn't tell you anything about margins. It just assumes bigger is better. And then you move down and you say, okay, maybe EV/EBITDA, but that has problems as well. It avoids, depreciation, etc., coming into play, which is the drawback of PE multiples. But even EV/EBITDA doesn't take into account capex, for example, as Warren Buffett famously kind of quotes on management assuming that that's the tooth fairy pays for it, etc. I'm wondering, why is it you think that free cash flow based multiples are not so popular. And I'm simply thinking of, taking operating cash flow and then minusing off CapEx to kind of arrive at some sort of proxy of free cash flow and then use a multiple. Why do you think in practice that's not that popular? Thanks.
The short answer, I think, is that you will get to too low valuations and that don't rhyme with where the market actually is. When I myself invest in private companies, which have like zero liquidity, I know I have to stay in these companies, at least for the foreseeable future, then I look at what my cash flow to price yield will be, because that's the actual yield, the real value that I'm looking forward to. And that's what I will get in the end. So for me, the free cash flow yield is like almost the only really relevant value. And I also simplify that by actually saying that over the long run, unless this is a hugely capital consuming company, then the earnings yield and the cash flow yield, they will actually be the same. If you let a company run go into runoff in the end, then once the company is completely over, then the cash flow and the earnings will have been the same. So it's just really just a periodization. But I think that coming back to the question, the short answer is that it's kind of too real to look at the free cash flow, because you will realize that the value of the company is probably much lower than when you use the other methods. So typically, after a long bull run, then the sell side analysts they gravitate towards more and more forgiving valuation measures in order to be able to price companies higher and more or less fool the buy side. So you start maybe in a severe downturn with looking at free cash flows and assets, like the real deep value company valuation models. But it's been a long time since we had to do that, and since there actually were obvious mispricings on the downside, and then over time, over a long bull run, you go more and more to adjusted EBITDA numbers, since the buy side they like to hear low valuation multiples. So you just keep going higher and higher and more adjusted up into the P&L. So that's the pragmatic I think answer to that. And it can be quite daunting looking at what the actual valuations are. So I get it that there is a lot of money, a lot of capital that's just sloshing around in the markets, and it has to find somewhere to be. And in order to more or less dare to invest anywhere, you have to come up with these creative valuation methods that don't really have I think, solid foundation. All right, no questions.
Mikael, there is a question for you in the chat.
Yeah. All right. Let's see. An example of risk. Could you maybe clarify, Xuan Zhang, what you mean? Can you give us an example of risk? Well, what I mean by risk is the likelihood. What I mean is the relative range of likely outcomes for a fundamental variable. So, for example, if sales is 100 now and I project 160 in 4 years, but I think that it's it will probably lie between 150 and 170, then I would say that difference between 150 and 160, that is that's the actual risk, and that would be like 10 compared to 15 to 150, so like 7%. That's what I would call the actual risk. I'm not sure if that answered the question. Otherwise, just write again. All right. So back to this picking apart into components. So we have the we have the likely CAGR for the stock price. We have the risk level. Combine those into a risk-reward ratio. So, for example, if let's say we have calculated a future stock price CAGR of 20%, so an annual appreciation rate for the stock by 20%, we have a risk level. Yeah, I didn't mention intuition here before because I don't think that the risk level really can or should be quantified in a real and an absolute number, because we don't know. However, I think that's what we can know is the relative risks of different investments, and we can put those into more or less arbitrary numbers. Those numbers, well, they could really be anything, but to keep the risks somewhere along the order of size of the standard deviation of the stock price or the standard deviation of the fundamental variables, I think that's constructive. So if we have a CAGR of 20%, and then we have some kind of either stock price standard deviation of 20% annually, or maybe the fundamental variable has like a standard deviation of 5, 10, or 20%, or we simply make a ranking of our investment alternatives and just give them a number, like this one gets 10 because it's a low risk, this one gets 15 because it's an average risk, and this high risk company gets like a 20 or 25 like number, and let's make those into percentages so they are comparable in size with the CAGR as well. And that means that you then can calculate a risk reward ratio which will be more or less close to 1, which is just the reason I do that. I mean, it sounds almost like it sounds naive and stupid, but the reason it works is that it's intuitively easy to understand, and you kind of understand that if you have the potential of making 20% a year, but your kind of risk assessment is also 20%, then that gives you a ratio of 1, and anything with a higher ratio than 1 is better, and lower is worse. And this gives you a tool to actually rank your investments in an apples to apples basis. And after putting together a portfolio based on the risk reward ratio, and we'll get there, you actually make the investments. Let's see here, Lucy B, you have a question?
Yes, I just have a quick follow-up question regarding we just talked about regarding how to measure risk. So you mentioned either standard deviation of price or, I mean, fundamentals. So I guess you're talking about the movement, I mean, the price movement. So like the volatility of the stock. So not the risk of losing your principal, but the volatility risk. Is that the right understanding?
Yes, but I also want to stress again that that is only like one input to your own overall thinking. So I would still never just simply use the volatility of the stock as an assessment of risk, but I will take it into account. Actually, the place I typically start when I look at a stock is simply actually whatever I said before about the technical analysis. I actually just look at the stock price chart, because if a stock price has been like if the highest it has been was 160 and the lowest was 80, then those are the ranges that are pretty likely somewhere in the future as well, since the total investor community, at least at one point, agreed that 160 was an okay price, and at another point that 80 was an okay price. So I do take the actual stock price movements and ranges into account, but I don't use it like in that mathematically precise way that you can get tricked into doing if you it's all too easy to just take numbers and take them for being the truth. So sure, I do look at the previous ranges, and I do look at the volatility, but that's not my that's not the end point in my assessment of the risk. My main input will still be the uncertainty for my accounting forecasts, and those are informed by previous accounting outcomes.
Is there any way to quantify them?
Yeah, sure. I mean, if you have a long enough series of quarterly reports, then you can calculate standard deviation from those as well. It will be less precise, which is kind of good, because you won't have enough data points. But just take the, for example, the annual or quarterly, annualized quarterly growth rate for sales, for example, and then just calculate the standard deviation for that number, and then you will have a pretty good intuitive feel for the variability of sales. Well, you probably would need to clean that data from extraordinary events and stuff like that, but in general, it's I think it's you can get an intuitive grasp for it by just plotting the data in a chart, and if you plot previous outcomes, let's say quarterly growth data or sales data, and then see what type of numbers in the future would fit into that picture without looking weird. So that's and you can either do it quantitatively, well, by actually just calculating the standard deviation for sales, or you do it more graphically and look in a diagram what types of future numbers would actually fit the data, would fit into the picture without looking weird, because that's it's like if you make when you make forecasts, the forecasts should fit into like a kind of a range where you wouldn't be surprised, and if you are surprised, well, then that is a true surprise. So you kind of make bets with yourself or with an intelligent counterparty about where would I really like to bet against you whether my forecast is higher or lower than a certain number, and making that bet, you will take everything into account, and I think it's better to actually look at it in more graphical way than trying to calculate a precise number, because I think that we humans are pretty good at pattern recognition if we allow it, and therefore I think it's better to just view the data graphically and see what type of data points in the future would not surprise me. All right, Jingxian.
Hi, Michael.
Hi.
Hi. Thank you for sharing. I just want to follow up the previous questions. I'm thinking about this risk or reward ratio, and I just want to make sure that you said if we have quarterly data of a company, we can calculate the risk. We can quantify the risk by calculating the standard deviation of the previous sales. But all these data were historical, right? You mean we should use the historical quarterly data to calculate the standard deviation?
Okay, you are a bit quiet, but I think I got most of it. So let me start by saying that this is very difficult. To assess the risk is difficult, especially if you are looking for an absolute quantified way. I look at it more as a kind of ranking, that you try to rank different risks. So let's say you have Walmart, Meta Platforms, Alphabet. You have a couple of companies that you are considering investing in, and then I think it's more straightforward to just try to rank them in terms of risk than actually calculating like a precise number. Sure, you can still, if you want to, take quarterly data as far back as relevant, and by relevant I mean as far back as that the company has actually really been the same company, not too many acquisitions, not too much growth. Also that data, in case you really you should probably like clean it for extraordinary events as well, and you can tell already by now that this whole effort is fraught with a lot of uncertainty and errors. And therefore, I would rather suggest that you think about what type of industry, and once again, just plotting the data for a few years back quarterly, and compare it to the other investment alternative. Just compare the scatter diagrams and see which one looks more risky. Which one would allow for a wider range of guesses in the future without looking weird. So it's a question of comparing these various alternatives with other alternatives in terms of risk, rather than trying to set a very precise number.
Okay, sorry, just now I had some problem with my microphone, so maybe you didn't get my question clearly. My view is because in this ratio, I think we should quantify risk and reward in an apple-to-apple method. And here you quantify the reward or the return using the stock price change. So you are using a forecast method. You have a forecast perspective, but you quantify risk using historical data. So I'm not sure whether this is correct, because in my previously I usually calculate this ratio using the downside return or the downside to quantify risk. For example, in my base case, I will have perspective for the fundamental, and then I turn this view into my projection about the future stock price in the base case. So this I can quantify my return in this case, and then also calculate my worst case or my bear case to quantify the risk. So this is the downside risk. Then I can figure out a comfortable enough stock price for me to entry. So I just want to listen your opinion for this method.
Yeah, well, I think it sounds like a sound method, and the proof is probably in the pudding, meaning that you will well, you should probably back test it on previous data, or start taking notes now and see how things turn out. But I think it sounds like a theoretically sound method. I don't think there is definitely not just a single way of going about this. As long as the thing is that what you really need to be is be systematic and keep notes of exactly what was driving the original investment, and then make an objective evaluation afterward to see what really happened here. How much did the fundamental move, and how much did the valuation multiples move, and do they seem over time to be rhyming with the original risk assessment? So, like, my framework, it's based on making a projection for the fundamental, making a risk assessment for the fundamental, and then combining these into a probable CAGR for the stock price, and comparing that to the underlying risk. And since I both had the fundamental variable as the value driver, and the fundamental variable as my risk assessment, it's then the system like holds water. But I think yours does as well. And the only like arbiter here will be whether it works or not. But I think that's, as long as you're systematical about it, and not least just keep notes, and use those to adapt the method over time. Then yeah, I think it sounds like well, actually yours sounds more theoretically sound than mine. But I like to keep things maybe slightly simpler. Yeah.
Okay, thank you.
All right. Let's move forward. Well, here we have meta platforms, just to make a very simple example. So right now, the price is about $200 per share, as you can see from the chart. It's moved down a bit since they changed name to Meta. The market cap is $550 billion. Their annual sales is $118 billion. So the price sales is 4.7. And the question then, just practically, is what type of sales forecast can we make, and what would be like a good, our best guess of where the price sales might end up 4 years into the future. And as I said before, like in order to assess the future price sales number, my first stop would be to look at the company's own history. All right, maybe I should back up a little bit. So this framework, it takes into account like what the market typically actually is doing, what other investors are doing. So this is not really like a hardcore fundamental absolute valuation. Since I take into account the type of valuation multiples that the market has typically awarded this type of company, because there's really no reason for me to try to question the market's wisdom over at least over shorter periods of time. But after looking at, like, for example, price sales, the range for price sales for the company, and also the range of similar companies, what type of price sales have they typically been valued at, either where they are exactly now, so like the average, for example, for Alphabet and Adobe and Salesforce, etc. And also the historical range for similar companies. You could also compare it to where the market is, not least the spread between a certain industry and the company's peers and the market. So at various points in the cycle, the valuation spread between the market and a certain industry tends to vary. And then finally, I also use some kind of an absolute anchor, because if let's say the price sales number would be like 100 for Facebook, there is no way I could justify that, the reason I know that that's not justifiable in most cases is that looking at what they can actually create in terms of value from a DCF standpoint, with a range of values that are not crazy, then I have like an absolute anchor that says that, well, certain valuation multiples are simply too high or too low. Sorry, Jingxian, you have your hand up still. Do you have a question? No. Okay.
Sorry, no.
Okay, sure. All right. This is really the formula we're talking about all the time. It's super simple, even though in a chart like this, it's kind of, I don't know, every time you try to write something down, it starts looking complicated, but it's really not. And here is the actual the answer to the question: how do you assess future valuation multiples? So just to make sure everybody's on board with the actual model, we have the stock price today, and we are looking for ways to find out the stock price tomorrow. Do it by analyzing the price into a fundamental and its valuation multiple. So like earnings, sales, equity, assets, cash flow, and return on equity, or price earnings, price sales, price book, price cash flow, EV, EBIT, etc. Very straightforward. You can add on other fundamentals as well. It could be like square meters of real estate, or it could be number of employees. It could actually even be costs. In biotech, actually, the price-cost ratio is sometimes used as a valuation method. And then there are various ways of getting from today's fundamental to tomorrow's fundamental. I like to model First, you have the actual fundamental, like for example, sales. That would be F. If it's a completely stagnant company, then today's sales will be tomorrow's sales. Or you model the growth rates of the fundamental. Typically, I plot these as charts to see what kind of growth rate patterns do I see. Is the growth rate tapering off, or is it accelerating? Should I expect like a kind of an S curve for the growth rate, or more likely like a topping out and then coming back down to like a GDP order of size in growth? Another one is looking at the rate of change of the growth rate, so FBIS. Typically, this one is best correlated actually with the stock price movements, because it gives a kind of an early warning of when the growth rate will start, well, either accelerating or decelerating. So it gives you, well, it's remarkable really that the market doesn't see through this, but somehow in every company and industry, they go through like a hype curve, and just looking at whether the growth rate is increasing or decreasing from a high or a low level actually informs where the stock price is going in the future. I mentioned the S curve. Maybe there is like a product launch that will affect how today's sales will go to tomorrow's sales. You have to take into account maybe what's happening with competitors and suppliers, whether customers are the clients, if they have enough money, if they are showing patterns of exhaustion, for example. We will come back to that later, but for example, analyzing numbers like days of sales outstanding or days payables outstanding, that shows your client's propensity to pay on time. It shows the company's relative strength in terms of actually sending out invoices and getting them paid, or offering clients longer payment terms, easier payment terms. And on at the other end of the spectrum, the company does the same to its own suppliers. Do we pay on time? Do we have to pay on time? Or do we have a relative strength towards our suppliers? That means we can kind of fleece them for cash flow for more than we should be. So all of these things, they kind of inform how today's sales will take us to tomorrow's sales. And it's a combination of the company-specific micro factors and the overall like macro factors like GDP growth, interest rates, inflation, whether it's easy or difficult to get financing from banks or the stock market. And it's also a question of storytelling, of the narrative, because certain narratives, they typically mostly affect the valuation multiples. So they will inform how we get from today's valuation multiples to tomorrow's valuation multiple. If there's a certain hype narrative right now, for example, around software as a service companies, then that can have led to an overhyped valuation multiple now that will normalize in the future. But there's also a fundamental aspect to the narrative, because actually narratives, they permeate the society in general and can affect sales. So that can actually explain, for example, why the iPhone has been so popular, because the narrative that you should have an iPhone creates this kind of pervasive fad that you want to associate with the iPhone. So a narrative should not be just dismissed as an unwarranted valuation hype. It can actually drive the underlying fundamental as well. So this answers the question about how I assess future valuation multiples. So I look at the historical range for valuation multiples, and I look at the historical range for the actual company, for its peers, and then I also establish what I would say is a theoretically warranted absolute valuation range. So these first two, the historical range for the company and the range for peers, those are more pragmatic, market-based views that inform a likely range to end up in. But then I also want to make sure that that range isn't just like too ridiculous. So I calculate like an absolute value based on either like a DCF kind of valuation, but I don't really go through all the steps of a truly correct DCF analysis. I typically am more inclined to use the average historical market multiple, because that's kind of the ultimate wisdom of the crowd valuation multiple. It says that if over 100 years of time the market keeps gravitating back to around a multiple of price earnings 15, then that's what's all of history tells us that takes into account all kinds of outcomes and risks for the overall economy. And if your company, if you don't have really good reasons to say that it's completely different from the rest of the economy, then the market multiple should be your best guess for the future. However, you still have to take into account that which multiple, because as we talked about before, there's a difference between price sales and price earnings, because certain industries, they will have higher margins or lower margins. So let's call the market multiple the market relevant multiple, or the industry multiple. Yeah, the question here, we are trying to buy value. What we really want to do is establish what is it that I'm buying. I mean, I have £100 here, and I want to put that into work, buying something that's worth at least 110. So the things I can buy are either I buy profits. This is like the discounted cash flow view of value. I'm buying profits. All right, so I have like a forecast series of future profits, but what's this actually worth? So that's one way of viewing value. Another is buying a better yield than the alternative. That makes that means we don't really have to go through all these like non-intuitive calculations of what is really 134 in earnings 5 years into the future. What's that really worth to me? It's not. Well, sure, you can calculate it with a discounted cash flow formula, but what does it really mean? How much do you really want to pay to get 134 in 6 years' time? I don't think there is a good answer to that, especially considering the uncertainty of that number. So that's why I don't really like the idea of trying to calculate the total sum of uncertain future cash flows. I'd rather than, as I've said before, I'd rather try to set an estimate for a certain year and guessing what the market will value it once we get there. Because taking the sum of these future profits and calculating a net present value and try to form some kind of idea of how much of that net present value should the market value the company to today at the market. And if let's say the stock price is 100 and my DCF sum will end up at, like, I don't know, 200. So what do I do with that? Should I really think that the price should go from 100 to 200 today? I think that's completely irrelevant, and well, you can't really make an investment decision based on that. Yeah, and the other here is this buying a better yield than the alternative, and then we come back to that cash flow yield, for example, or earnings yield, and I think that this means that you don't really have to make too many guesses about the future. What you really do is you assume that things are more or less in order as they are, and if a company makes a profit of 7 per share, and then the stock price is 100 per share, so it's a 7% yield, and it's a sound enough company, and I don't have any real reasons to make any extraordinary assumptions, then I do get a GDP based real earnings yield of 7%, and then I can compare that to other yields. And a third way of looking at what the value I'm buying is that I'm buying change, and this is the formula I've been talking about all the time, and I always get back to it's that I'm buying profit growth and valuation growth, and they can move in so what you need to do here is make an educated guess about both, of course, but typically, unless you have good reasons to do so, you should not assume big changes in the valuation multiple. Sometimes you should, if there is an industry that seems obviously overhyped, then you might dare to make that kind of guess. But mostly, one should focus on the changes for the fundamental variables. Let's see here in the chat. Okay. But if we are talking about discounting cash flows, what does it really mean? Well, it's discounting. So what you do is you really, deduct some value from the future profits, in order to say what they're worth today. The question is, what discount rate should you use? I really don't really go this way. Rather than trying to estimate like a theoretical discount rate, I go the other way around, and I estimate a future price, and then estimate the annual compound growth rate for the price. Maybe this is an important point to make. I think that anything less than a 10% discount rate, that's just completely useless. It's the capitulation. It says that you don't really. It's kind of a sell-side analyst disease of always like reducing the discount rate downwards in order to create higher and higher target prices. And often you see discount rates these days of like 5, 6, 7%. What that means is that you bake into the investment cake an annual return of that discount rate. Because if you keep buying a stock up until the price where your DCF lands, given a certain discount rate, then that's what you will get annually. And assuming stock market risk in your portfolio, and it's completely unnecessary to assume that type of risk unless you can expect at least 10% return per year. So anything less than a 10% discount rate, that is just capitulating and just trying to force yourself into a market that's too expensive. Yeah, this is more of a philosophical thing. When you analyze the stock price from a fundamentals and valuation multiples perspective, what you really need to ask about the situation, about the company, about valuation multiples, and about fundamentals is what has to change and what cannot change between now and the future. So, for example, what has to change? One thing is you probably require sales and profits to grow at a certain pace. But you could frame that in a way that what cannot change is, for example, that the average annual growth rate for the fundamental variable cannot be lower than 7%. So that's really assuming a status quo for the growth rate, and that is often the best way to look at an investment. You have a certain company. You have a situation where it has a market share, it has a raison d'être, it's there, it's existing, clients like it, suppliers honor their agreements, and in case you don't have really any extra information, you can safely assume, or you have to assume, that this situation will be ongoing. I think what many new investors, the mistake they make in the market is thinking that they can foresee big changes, whereas I think that what's mostly going on is that the exact same situation as is now will prevail tomorrow too. And the problem, though, is to identify what actually is the situation we have here. What are the relevant variables that will stay exactly the same? And for example, one can be the growth rate. It could also be, as we talked about before, the rate of change for the growth rate. So, for example, like a tapering off of the growth rate. Let's see. Okay, Lucy asks if I'm talking about US equity only. Feel free to speak up and just clarify more. I mean, I typically invest mostly in US equities, but I don't think there's a difference. I think all equities are equal. Lucy.
Yeah. Right. So I think it refers to the discount rate should be higher than 10%. So I wonder for example, Japan stocks, shall we use like a lower discount rate?
Okay, that's an interesting question. I don't think so. There's no way that I would invest in a company based on a lower than a 10% prospective return. If I were to use a lower discount rate for a Japanese company, for example, then it means that I pay more for the same thing that I get somewhere else. And there's, well, I don't see the theoretical basis for that. I'd rather just not buy Japanese companies. No, I'm talking generally. All types of stock market risk investments should require at least a 10% return. Yeah, that's.
I'm just a little confused because like the interest rate in different countries are different. Like, are we gonna factor that in?
Yeah, well, maybe there are two ways to look upon this. Since I don't have to invest in a specific country, then I can just avoid doing so. So therefore, I am free to invest wherever I can find at least a 10% prospective return. But let's say you are a pension fund manager based in Japan and you are required to invest in Japanese stocks. Well, then they have a problem. Then they have to they have to think of the in relative terms, and they have to, well, let's say that their best investment idea, their best alternative is just 8% return. Then sure, they have to buy that, and maybe if they can finance it with a very low yielding debt, then they can make a profit from the spread. But just based on like a naked stock market investment, then I don't see the reason where I should go anywhere and invest my capital anywhere where I assume typical company risk and stock market risk without getting at least a 10% return. And John asks here, how did you come up with your 10%? What ground spaces, etc.? That's completely, oh, well, there are two ways to look at that too. One is that over 100 years of history, the average valuation for the US stock market, the Standard & Poor's 500, the average valuation has been such that you have gotten a 10% return ex post. So if you bought the stock market at its average valuation at any point over the last 100 years, you would have gotten a 10% annual return. So that's like a kind of a it's the market wisdom of how a market should be valued and how it has been valued. Another way of looking at it is that if you can't get well, like a 5% return, it's just too little to make a difference, and it's not worth the time, the effort, the feeling of assuming risk. But once you get to 10%, it's kind of like we have 10 digits, and I know how this sounds. It's pretty naive, but it's just that somewhere there we start to see the difference, like a 10% change in something that's tangible. And you can put in like an effort anywhere else in order to create those 10%. Maybe a third way to look at it is that since markets over time tend to produce 10% returns per year, if bought at an average valuation level, then there will always be interesting alternatives that will yield at least 10%. So it's a combination of just history, gut feeling, getting enough, and I would kind of guess as well that since GDP growth fluctuates between, let's say, +5 and -5% in the extremes, then you would want anything that assumes this kind of overall economic risk in terms of corporate earnings. At least a 10% compensation per year is just about enough to compensate for a bad year, something like that. It's not like mathematical or theoretical in any way. It's just like pragmatic. It's how history has been, and it's a level where you can always find investments that will produce that level of return for an average risk. Let's see here. Follow up on Q above. Can you give an example of how you would go about determining the discount rate for a US company? Once again, this is how I would do it. I don't really use discount rates in that way. So what I would do is I start by making a forecast for, let's say, the sales number in 2025. And I make some kind of an assessment of how uncertain that is. And then I make a forecast for the valuation multiple for that year. So I calculate a stock price and a stock price range for 2025. Then I calculate the CAGR, compound average growth rate for the stock, and let's say it's like 20% per year. Here is where you probably could say that the discount rate comes in, because what I would do is take that 20% CAGR and compare it to my intuitive, subjective ranking feeling of risk. You could frame it as comparing it to the discount rate, but I don't. Rather than applying a discount rate of an exact number, let's say 10 or 12 or 15%, and calculating a net present value today, I'd rather calculate the CAGR, and let's say it's 20%. And then make an assessment of whether that is enough to compensate for my subjective feeling of risk for that company. Sure, you could still say that I still have to come up with some kind of a discount rate or at least risk assessment. But if I were to apply a discount rate first, then I would be forced to come up with some kind of a number, like 10 or 12 or 15%. Sure, I could calculate the net present value for all various discount rates and plot them on a chart, of course. I mean, both these approaches are really just two sides of the same coin. But I find it more intuitively appealing to calculate the CAGR and then get a feel for if that is enough. Because look at it this way: if I have 10 stock alternatives and they have CAGRs of 20, 25, 15, 12, 8%. So I have a list of CAGRs for these different companies. When I look at them and compare them and think about which one of these companies do I want to invest in, then it would be less precise to have a lot of net present values, which would make it difficult for me to keep track in my head of exactly what kind of discount rate was it I used for that company and that company and that company, and try to compare that in terms of in order to come up with which one I should invest in. I'd rather have a list of CAGRs, and having that list of CAGRs up at the same time, it's easier for me to think in terms of like, okay, so I have a CAGR here of 25 for Meta Platforms, and I have a CAGR of 8 for Walmart. Which one is more appealing? Well, it would probably depend on where I am in the cycle and where I currently, where my subjective feeling and subjective feeling of the relative risk between Walmart and Meta Platforms is. So, and also whether I am interested in getting the potential of that 20 CAGR, or if a lower risk 8 CAGR is more appealing at the time. So I get it that what school tells you to do and what you kind of also in the end want is, but what really is the net present value today? So I know how much my upside is. But I'd rather calculate the annual likely upside and just try to keep a relative risk assessment in the back of my head while doing this. So my focus is always on like the CAGR first. What is my potential, and then the risk assessment, which could be quantified as the discount rate. I want that to be held as openly and loosely as possible, because if you start quantifying the risk and the discount rate, then you forget that is your least reliable variable in this whole equation. So therefore, you should come up at absolute last point and only be used in a kind of an intuitive fashion. Does that make sense to you? Okay, here's a thing that's I often in the discourse about investments, I hear that you should really just focus on whether a company is it a good company? Is it run by good managers? Are the main shareholders, do they have a great track record, etc.? And that kind of price never really matters. And I would say it's the complete opposite. It's the price. Actually, the price determines your return. It's easy to see if you look at bond prices, because then you know that if you buy a bond today that will give you 100 in a few years' time, if you pay 90, then you know that you have an 11% return guaranteed. That's exactly how it is. The thing with equities is that it's actually the exact same thing. The future is what the future is, even if we don't know what it is. But we are paying for those future profits that will materialize, whether you are a shareholder or not. So those you will get. And if you pay 100 for them now, that will bake into the cake your return. You don't really know what it is, but you can make a fair assessment. But the important message here is that once you pay that price, whether it's 100 or 200 or 50, you have kind of sealed your fate. Sure, you can of course you can trade in between, but that's that's another thing that does not have to do with the value investing part of it. So that's the trading part, and of course you can have luck, and there can be a bigger fool, and there can be a hype or a crash. But in the actual process of fundamental value investing, once you pay a certain price, you have locked in your return. So I think that's it's a very important concept to just keep in mind, that you can't just give up in terms of the market and just assume that today's prices are warranted or theoretical, sound, or just givens. And if it's a good company, you will get a good return. That's definitely not how it is. It's the price that matters. So just want to hammer that point home. So that's in terms of fundamentals. So what you're really doing is that you're when you're investing, you are trying to buy future cash at a discount. That is our job. And once we get that cash in the future, that it should be more than we paid for it. Anything else is trading, and it's just guessing other people's behavior, like hoping for bigger fools to take the shares off of our hands. And then, so that's the fundamental part. Then we have the risk part, and that is that always ask yourself as well that how, when, and by whom is that future cash guaranteed? So when you buy a stock in the market, what you really should think about is who is going to buy this from me in the future, or if I can't sell it to anybody, if I have to hold it, how will I get my cash back? And so one answer to this question can be, well, I will get dividends, or at least I will get profits, which implicitly create my value. And if they are big enough, and even if they are not distributed as dividends, then they will accumulate in the company, and sooner or later the company will have accumulated so much assets that it's impossible for the market not to recognize it, or else the owners would liquidate the company just to get hold of the value. But it's quite unlikely situation. But at least theoretically, if you have an answer to how that value will come back to you, in terms of accumulated profits and dividends, then you know that you bought that value for less than it was worth. It's also very important is when. If the when part is like 20 years into the future, then you really have no idea whatsoever. And this is the trouble with a lot of startups and biotech companies. Often they never get to the when. Maybe theoretically there is a profit in the future, but just never materializes. And by whom? Either it's the company that distributes dividends, and it's the clients that pay in the revenue and make sure that there is a profit, or you're just hoping for a bigger fool in the market to pay too high valuation multiple. That's some kind of a hype peak. Also, I once again want to just hammer home this point that the standard deviation of the stock price, it has quite little to do with the actual risk level that we are assuming. I really think that the risk we're talking about is the risk that the fundamental variable deviates from our forecast or from previous trends. Well, here's the Meta Platforms example again. I'm not sure if there's any real reason to go through it right now. Maybe this one. I think maybe we have already gone through this in terms of like forecasting, for example. We talked about that earlier. That's assuming like a status quo for either the fundamental variable, the growth rate, or the change of growth rates. And what we do is we compare it to the company's own history, to its peers, and to various patterns. So it always comes down to trying to establish patterns that are stable and reliable. So sometimes it's the actual sales that is showing reliable patterns. It could be, for example, a cyclical company that shows a very stable cycle, but it's not really growing. Or it can be a certain type of growth rate. Maybe it's it's growth more or less exactly as nominal GDP, or it has a reliable spread towards GDP growth. Or some other pattern. So what you really should do is you start by just plotting the variable. You start by plotting sales and earnings, or maybe margins, and you just try. You keep going through the various accounting variables until you find some variable that has a stable pattern. It won't be the same variable that is stable for every type of companies. Some have a very stable sales pattern, some have a very stable margin pattern, and some have other patterns that are stable. So you just have to go through the list of P&L items and balance sheet items and cash flow items until you find something that exhibits stable patterns. Then you can start making forecasts. The same goes for valuation multiples. It will not be price sales for every type of company and industry, or price earnings, or price cost, or price book. But typically, sooner or later, typically you will find some variable, both in terms of valuations and in terms of accounting, that do exhibit stable patterns so over time, and then you can dare make forecasts. And it's but the patterns will still be uncertain to some extent, and it's the level of uncertainty for the variable that you choose that will be the level of risk that you have assumed in your investment. So it kind of all ties together once you lock it down for that specific company or industry. So there's no one size fits all, but you have to go through the list until you find something that you can use for your forecast. And this is also important. If you can't find something that shows stable patterns, then move on to another company. Nobody forces you to invest in any country or company unless it's worth your risk and time. So there are many thousands of companies. So if the company you're researching seems difficult, then just move on. go somewhere else. There's no reason to fighting difficult fights. John asks, where is inflation in this? Is it in the risk compensation or time compensation, or is that in your nominal growth of cash flows, or both? Well, I've completely disregarded inflation in this point, or up to this point. I really don't take inflation into account in any explicit way. I mean, I do have my sales forecasts. They are nominal, of course, so they need to take inflation into account in some way. That will be partly captured in backward-looking data, but then again, if I think that the price rises and an increased monetary expansion will affect sales for that specific company, then well, I have to take it into account in my sales and profits forecast. But I would say that will, we never really talked about how to project fundamentals. So, for example, when I said that you have to project, for example, sales, then sales will be in its turn broken down into various products and their average selling prices. So you have unit forecasts and price forecasts. So it could be, for example, in Apple, you have the iPhone and iMac and then all the different products, and then you have to assume prices for these different products. And when estimating future prices for Apple's various products, then inflation comes into account there. And in terms of risk compensation, no, I wouldn't really say so. In my assessment of future valuation multiples, then inflation will have an effect, but well, I wouldn't really say that I take inflation into account there either. I don't really have any reliable way of saying where valuation multiples will end up, depending on what type of inflation environment we have or not. But well, typically higher interest rates that accompany higher inflation rates will result in lower multiples pragmatically on the markets, but it doesn't really affect the actual value of the companies. So you have on the one hand, you have what will markets likely do? Where will multiples likely end up? And that's taken care of in the formula, the price equals F times V. In terms of likely future valuation multiples, but not really in any other way. So, as I've said a couple of times, the F times V range for forecasting future prices, what it does, it takes into account actual pragmatic market behavior, how it has used to behave and how it's probably going to behave in the future if everything stays the same. It takes into account likely valuation levels, whether those are warranted or not. So just likely ranges. And it also takes into account likely business development. So that's for the fundamental variables. But what they don't take into account, really don't take into account, it's absolute valuation, which is what the value you will actually get unless you can sell it on the market. So that's a different thing. That's where we need the anchors in terms of I think, let's see, I can take this one. This is meant to be it's meant to be naive, but it's also meant to be remembered, because this is kind of also an absolute anchor. Like, if as a value investor, the first thing that I look at is, at what point in time am I paying less than some kind of earnings multiple of 10? And by that I mean, well, the earnings multiple, it could be EBIT or EBITDA or net profit. It's the point here is to not make it too precise or theoretical, but just give yourself like the first big picture perspective of what you're really trying to do here. You're trying to buy future profits at a discount as cheaply as possible. And if you can find a company that grows quickly enough or is profitable enough that within a few years, that it's quite close in the future, with a significant probability. Notice how vague all these terms are. You're looking for an investment that will be priced at less than price earnings of 10 within a few years. The reason I choose 10 is that typically the market gravitates towards 15 over time. And when you buy the market when you have bought the market at around PE of 15, anytime over the last 100 years, you have gotten a total annual return of around 10% per year. So that is simply how the markets have tended to work over 100 years. Therefore, I consider anything that I can buy significantly cheaper than the average market history, unless it's a significantly different company than the general economy. Then buying at less than PE 10 somewhere in the close future, that will be a value investment. But if I instead buy a company that's significantly more expensive than the market has tended to be on average over 100 years, then I consider that like a speculation in growth, or just hope that somebody else will buy it, or hope that this company will prove to be significantly better than the average company on the stock market. And that is hoping. That is a speculation. So again, these are absolute anchors based on market history, and based on, if you don't really know, if you don't have a confidence in your ability to make a significantly different forecast for the company than you do for the average stock and on the market, then buying a future profit at significantly lower than the market average of 15, or significantly higher than the average valuation. These are like the dividing line between value and investing and speculation in a different future. All right. I'll start with Yingxian. So, do you buy growth stocks? Well, most people would say that I only buy growth stocks and hope stocks, since I typically buy things that today look very expensive in terms of these measures. But I would say that with my projections for the type of companies that I buy, I buy companies that I expect to grow very quickly, meaning that within 4 years' time, they do trade at less than PE 10. Maybe I could stretch that to like 5 or possibly 6 years. So for a typical investor, they would call my stocks growth stocks, but I call them value stocks because I always only buy value, and with value I mean that a likely price earnings ratio is below 10 in the pretty near future, defined as somewhere around 4, 5, 6 years into the future. If it's a small company growing very quickly and far away from market saturation, then I could probably look like 6 years into the future and say that if it's trading at P 10, 6 years into the future and probably still growing quickly, then to me that's a value company. That's investing. But I do see how most people would define it as a growth company. All right, let's see. Sam, go ahead.
Thanks. I had a question around your experience around value traps, and how does one go about identifying them? Is it falling revenues, falling margins, technology changes? And if you could just maybe give us some examples in your experience that of value traps you might have come across, because just having a cheaper PE multiple might lead one to certain value traps.
Yeah, well, value traps are they are traps because they are so difficult to spot. I don't really have a good answer to that. Companies that are trading at low valuation multiples already today, they typically have been picked over and picked apart from all possible angles by a lot of investors. And if there's anything the market is quick to do, I think it's to find free money on the market. It's the problem with the market is rather most of the time that companies tend to get overhyped or too expensive just because there's this liquidity premium on the market. I think that the first warning sign for a value trap should be that today's multiple is low, because it probably means that there is something wrong with the company. Some variables to look at would be net working capital. So if the company is not producing, if it doesn't convert profits into cash flow, then that might be a warning sign that the company will never really be able to distribute profits to you as an investor, but it would just keep tying up capital in having too high days sales outstanding and too low days payable outstanding. So DSOs and DPOs and net working capital in relation to total sales. That could be one warning sign, especially if they are trending in the wrong direction. So DSOs and DPOs are probably where I would start looking. Another place to look could be in valuation ranges. I mean, even if the price earnings or price book multiple or what have you, price sales multiple, even if it's low today, well, if it has been low for a long time, or even trending lower, then that's kind of a warning sign as well. There's some kind of market wisdom that says that this company has a stable low valuation. On the other hand, like what the opposite of a value trap would be if the valuation multiple has taken a big step down recently, and without there being big changes to the business, then that's probably some kind of market anomaly that could be a really like deep value opportunity. But I think most investors would agree with me that it's always better to buy companies that have an inherent growth rates at least as good as GDP. There are a lot of interesting deep value companies that do not grow quickly, but they can be tricky to find and to be certain that there actually is value there. But as long as you buy companies that actually grow with GDP or faster, then time will always work in your favor. The markets are pretty bad at discounting growth in the end, at least above par growth. If a company grows faster than GDP, that means that they are doing something right. They are, in a sense, taking wallet share or market share in some form at least, and that typically pays over time. At least if you, as we have discussed these past 2 hours, if you pay low enough valuation multiple and low enough price for the future profits. But I think when it comes to value traps, well, the two most obvious risks are buying companies that are stagnant or maybe with falling revenues or just stagnant revenues, and especially if it seems as if they are losing their relative strength in terms of their competitors and suppliers and clients, which will show up in poor trends for days sales outstanding and days payable outstanding. So DSOs and DPOs probably is where I would start looking for signs of trouble. All right, time for a break. For me, either we could take 45 minutes or come. Well, let's if you come back at 1 o'clock, would that work? Does that? Well, I'm completely confused now with the time at the top of the hour.
Yeah, that should be fine, Mikael.
All right, great. See you in about 54 minutes.